Hello everyone, welcome to this third and final part of private investment structures. So this section is going to be shorter than what we just did, and yeah, should be done before you know it. We're basically going to compare public risk, private versus public risk and return, and then that's it. That's pretty much it. Okay, so you see this diagram here. I just put in a lot of information into ChatGPT and it gave me this diagram, generated this diagram for me. But basically, what you notice is that over from the period of 2009 to 2019, I think that's a 10-year time period, the median net internal rate of return for the global private equity funds has achieved a return of 20.1%, which is quite high. This is the value here. So this is the median for the net internal rate of return for the global private equity fund. So this is in the private markets, of which, on the contrary, the S&P 500, which is an index for public markets, has had an average annual return of 11.8%. So you see that private markets have actually, on average, in that time period from 2009 to 2019, private markets have actually had a much higher return, which is why there's been an interest in private markets, right? Obviously, a lot more money is being traded in public markets, but returns seem to be higher in private markets. Okay, so let's jump right into this final section. You first list the differences between public investments and private investments. This should be straightforward. The public investments, remember, these are usually traditional asset classes. In terms of equity, in the public market, you have mature listed companies. In the private market, it can be venture capital, it can be growth equity, or it can be buyout equity. Your venture capital, this is early stage. Venture capital is early stage funding for startups with high growth potential. Growth equity, this is an investment in mature companies for expansion without control. So there's no control in growth equity. But then with buyout, you want to acquire control of companies, often by restructuring. I mean, a very common example is the leveraged buyout, right? Where managers take leveraged debt and then they buy the company and take control of the company. So that's equity. Number two, debt. They can be sovereign and corporate bonds. Sovereign is government bonds, and then corporate companies. That's on the public side. On the private side, it can be venture debt. Once you hear the word venture, it usually has to do with startups. So these are usually loans to startups, and often this comes alongside venture capital. Direct lending, these are non-bank loans. These are not coming from loans, and often they are done privately. And then mezzanine debt, these are a bit more complex. They are hybrid debt instruments with equity-like features. They are high risk, but also they have high returns. Then real estate, there's income-producing REITs. These are traded publicly. But there's also value-added real estate where there are moderate renovation or improvements to enhance property value, and then they sell it or they rent it out. Or opportunistic real estate, this is high risk. Distressed or underperforming properties that are then refurbished again, and then if you win, you get a very high return, but it's quite risky, opportunistic. In infrastructure, public infrastructure companies, these are owned by the government, or the shares are traded publicly on the public stock exchange. Then in the private sector, there's value added as well and opportunistic. Same with real estate, where there's moderate upgrades or of existing infrastructure to increase the returns. Also opportunistic infrastructure, where there's high risk investments in new or underdeveloped infrastructure projects. If you win, the risk is quite high, but if you win, you're going to make a lot of money out of it. So these are the different comparisons between public and private market instruments. And always remember that specifically for private markets, the returns are generated throughout the life cycle of the investment. Throughout the entire, there are going to be irregular cash flows from when the capital is committed up to when the money is then given to the investors, the limited partners. All right. So this is shown here, where there's a commitment, right? Where the LPs, limited partners, have made a commitment, right? But this capital has not yet been called. It has not yet been invested. Okay? And these are usually held in low return public investments. So they can put them in public investments on the stock exchange, and the returns are not as high as in private markets, right? And then the GPs call the capital to say to the LPs, you promised us money, you made a commitment, we want that money now. And then when the GPs get the money, the money is deployed. So the deployment of this money is going to result in capital drawdown, and this is going to, initially, when the money is called, there are negative returns here. The returns are negative, the net income, right? And when they get the negative, the GPs are going to start to invest that money in over a long period of time. So this is going to take time. It's going to take time. Hence, the returns are going to be slow, and you're going to have large unrealized returns initially when they invest in projects, in different private assets. But ultimately, the returns are going to be distributed to the GPs distribute the returns to the LPs, the limited partners, right? When the amount of money that was invested by the limited partners has been returned, let's say they invested 500,000, and after a few years, 4 years, the 500,000, we have it back, the internal rate of return is going to be 0, right? And then over time, the internal rate of return is going to increase until it reaches the compounded return at the end of the life of the project, 10 years, 15 years, 5 years, depending on the investment horizon of that project. All right. So to compare the public and private market risk and returns, I just put together a small table here, which will make things easier for you. These are the different asset classes that we spoke about, and we're going to talk about all of these. It's quite interesting that each of these we're going to discuss them in 10. That's what we'll be doing throughout this entire course. Remember, this is the first section. This is the first part. There are 7, so we're going to go through 7 parts. We're going to talk about equity, we're going to talk about debt, we're going to talk about real estate, infrastructure, special situations. If you don't get it now, trust me, eventually you will. So with equity in public markets is stable, right? Moderate risk, lower return potential, but you get your returns as dividends, right? Or when you sell your shares, the price has gone up, you also make a return based on that. In private markets, it's higher risk due to the early stage of investment, especially with venture capital growth, what. So potentially you're going to get high returns when there's a buyout, or the company is now being sold to either another private investor or through an initial public offering, right? So the key difference is that in equity, there is high leverage, high levels of debt, and there's a lot of volatility. Okay, but the return is potentially it's going to outsize equity in the public market. All right, so you make more money in the private markets equity. And in terms of debt, public markets are usually low risk. You look at the rating of the bond, and then usually it's low risk. Returns are predictable, and the default risk is very little. But in private markets, it's quite risky. This venture debt, these companies, most of the startups, they fail. The percentage of startups that actually survive is very small. So you need to be careful here. But if they make it, then you also make money. There's a lot of illiquidity, and it might take time to get the money back. So private debt, again, offers very high returns. The returns are quite high, but the cost is that there's greater risk, there's illiquidity, and there is instability from the issuer. Some of these are starting companies without a track record, so you don't know what will happen. With real estate, cash flows are stable through the real estate investment trusts. The risk is moderate again, and then the returns are steady. Private markets, quite risky, longer term, because they have to develop, or they have to start on a new project, opportunistic investments, and so forth. So there is in private real estate, there is higher idiosyncratic risk and market risk, but it offers greater return potential than the real estate. investment trusts, which are the more stable income and traded publicly. Infrastructure, it's lower risk for public markets as well, and they generate consistent cash flow, but it's quite high for private markets. The risk is quite high, and there's also execution risk, but the potential is there for higher returns. So private infrastructure involves more risk, right? Private infrastructure is going to involve more risk, but also it offers returns less correlated with the economic cycle. That's for private infrastructure. With special situations, these only exist for the private market, and these special situations are short-term opportunities driven by events or market conditions. So these are things like financial distress, or there's been fraud, or there's been litigation. So these are special situations where some company is going through distress, which means this is very risky. It's very risky, but the potential for returns is quite high in this instance, or you have these event-driven opportunities. So the private market strategies are going to capitalize on financial distress with the likelihood of achieving much higher returns in adverse economic conditions. So you're taking chances and hoping against these events or bad economic conditions. And yeah, so this concludes the first part of the private markets, and this first part is called private investment structures. I hope you guys enjoyed this. I know I did. I trust me, it's going to get more fun, so hang in there. Always remember this: you must practice. We're going to wrap this up with these questions here. Pause, try them, and then check the answers. So if you paused, we'll come back. This should be really straightforward. Which of the following is the most correct statement about returns over a private market investment life cycle? If you look at all the options, the one that makes sense is option number B. Once a fund's investment returns reach the amount of capital contributed, the fund reaches an internal rate of return of 0. This was specifically mentioned when we spoke about the life cycle of the investment life cycle in private investments, right? So that is the solution. And then let's see the first one. Private market returns are typically less reliant on price appreciation over a life cycle. So this is actually the opposite, right? Private market returns are typically more reliant on asset price appreciation compared to public markets. You want the value of your asset to go up by a huge amount for you to be able to make money. Right? Because remember, if you look at the return on the investment for these private markets, remember we said it's just the sum of the cash flows received over the sum of the cash flows invested, right? So you would want the cash flow that you receive when you sell your asset to be much higher than the money that you have invested. So it does rely, it's not less reliant, it's actually more reliant on the appreciation of the price of the asset, right? And then fund returns are typically positive during a fund's capital deployment. This is not true. Capital deployment is here, where you have negative cash flows. And then when now there is the distributions, that's when you have the positive returns. So this is also not correct. Okay, number 2, discuss 2 factors for why a private market investor should typically expect higher returns than public investors in the same asset class, such as private equity or private debt. So let's look at private equity, private debt. So remember, the way assets are priced in capital markets, they also consider premiums they can consider a risk-free rate, and then they put premiums on top. Maybe there's a credit risk, there's a risk of illiquidity, there's a risk of whatever, political instability. So they put a risk premium. That risk premium is to compensate investors for taking on risk in such an environment, right? You remember there's also a build-up approach that we do in portfolio management. in capital market expectations here, where you add premiums to taking of risk, right? So in terms of private markets, these private markets, there's greater uncertainty. There's greater uncertainty in these private markets, and hence the cash flows are unstable. Investors would therefore demand higher returns because of that. They want a liquidity premium on that. And then there's also greater illiquidity. There's uncertainty, and then there's also greater illiquidity in private markets. And because of that, also, they want to, all of these things are going to result in private market investors demanding a higher premium for their investments. Okay. Then the last one, discuss one fundamental asset characteristic that cause private real estate and infrastructure investments to usually be riskier than public investments in these asset classes. Okay. So you would find that in private investments in real estate, these are likely going to be new investments or projects that are completely run down, and then they have to refurbish this, especially when we discussed opportunistic investments. They want to increase the value of these assets so that they can resell them at a higher amount, or they can take out rentals at reasonable prices that will make them retain their investment, right? So they're very high risky in the sense that you are embarking on completely new projects, or you are taking on projects that are run down in terms of the infrastructure or in terms of the private real estate, right? And it might take time, and hence the investment horizon is going to be longer. It will take time for you to get back your investment, or for you to start having positive cash flows, right? So hence you're going to have a longer investment life cycle in the private investment in real estate and in infrastructure. You have the long life cycle, long investment life cycles in these projects. Okay, so this is some practice questions. I hope you managed to answer these questions based on what we have discussed. And in summary, just make sure you know all of these things in terms of what we're discussing right now. Remember, all of this is pertaining to private investments and structures. Private investments and structures. Okay, you must know the difference between alternative investments and private investments. There is no investor definition for alternative investments, but any investments that are outside the traditional asset classes, like your fixed income and your equity and some cash investments, are called alternative investments. But not all alternative investments are private. You can have hedge funds or real estate investment trusts, which are considered alternative investments, but they're not private investments. They're actually public investments. So not all alternative investments are private investments, right? So private investments are the ones that are not listed on any exchange, right? They are unlisted. And then you must be able to compare private and public investments. These ones are traded, these ones are not, these ones are liquid, these ones are illiquid, and so forth. Okay, the portfolio diversification potential of private investments, there can be diversification throughout the life cycle of the fund, but also private investments have a low correlation with public investments, and hence they can be used for diversification purposes in a portfolio. All right, understand the limited partnership structure and how the GPs and LPs are linked. Where the LPs have limited liabilities and GPs have unlimited liabilities, they are responsible for all the losses within that fund. LPs only lose to the extent to which they've invested in that particular fund. And then know the differences in terms of direct investment, indirect investment, co-investments. You must understand those differences, all right, in terms of the private investment methods, right? Then look at market performance, the differences, and focus mostly on the return on investments for private and the internal rate of return. And then the public market equivalence. Always remember, when you calculate the internal rate of return using the public market equivalence, you take the cash flows in the fund as they are given, but then you use your financial calculator, but the final value should be the private market equivalent terminal value. That's what you put at the end here for you to get the internal rate of return. So you take note of that. Then know the private market equities for the realized returns, which you said is the distributed to paid in, and then the unrealized return, which is also called the net asset value, or the residual. This is the residual value to paid in. Okay, when you add these two, you get the total value to paid in. And the private market risk and return versus the private versus public risk and return. Just remember, private is more risky, takes longer, but likely to get higher returns. If you do your due diligence and if you win in that market, you make more money as compared to public markets. Remember, we said when we started from 10 years, 2009, 2019, private markets, you have seen an average return on the global private equity index of 20.1%, which is greater than the S&P 500, which was around 11.8%, if I'm not mistaken. Yeah. So you likely get higher returns in the private market if it's done properly. Practice makes perfect. But for this section, guys, peace. I'll see you guys on the next one. Cheers.